Okay, hi there. Welcome, everybody. I am delighted to welcome you all to the Voyria interview series, and especially pleased to be joined today by Chris White, who is a managing director at the London firm SilverPeak. Chris will introduce himself in a moment, but by way of very brief introduction, SilverPeak are corporate finance advisors to the tech sector. Chris, maybe you could start by giving us a little bit of further information on yourself, your role within SilverPeak, and of course, SilverPeak. Maybe you can add some clarity to my very brief intro.
No problem at all. Thanks for having me on, Frank. So, as Frank mentions, I'm a managing director here at SilverPeak. I've been advising technology companies now for over a decade. Started my career on the buy side with a large corporate looking at M&A as part of their business plan. Then I moved after 5 years there into advisory, and I've been at SilverPeak for 3 years. SilverPeak is a corporate finance advisor, specializing in the areas of M&A and financing, and we exclusively advise technology companies across Europe.
Great. And you say corporate finance advisor. I mean, I think one of the areas that I wanted to really start us off on, Chris, is sort of demystifying or setting the stage on what this sort of, this space looks like. So, I mean, I hear about firms like yours categorized as bankers, investment bankers, advisors, corporate finance advisors, brokers, etc. How do you generally or how should people generally think about terminology like that vis-a-vis firms like SilverPeak?
Yeah, it's a good question. So I use the term corporate finance advisor because essentially what that means is I advise on corporate finance transactions, i.e. M&A, so a liquidity event, an exit, recapitalization, or a financing round, i.e. a seed, Series A, Series B. You could also consider us as a boutique investment bank, but the difference there being is we're not a full service investment bank. So people like Goldman Sachs and Morgan Stanley, they obviously offer a far broader, comprehensive set of advisory and investment services, whereas SilverPeak specialize purely on advising companies in M&A and financing. The term broker is certainly not one that we would consider ourselves. I would consider brokers as those individuals that have relationships on the company side and on the investment side and are essentially brokering that relationship. SilverPeak go beyond that and assist you in managing and negotiating and executing on the transaction itself.
Great. As a technology entrepreneur myself, pre-Voyria, it's incredibly difficult to make sense of who's who and who's fitting where in that whole space. So thank you for clarifying that. So in terms of framing the discussion, the reason I wanted to have you on, Chris, primarily was because the Voyria audience and the companies that we speak to are within the travel sector, travel technology sector, and they're typically earlier stage in terms of, looking at seed funding or a little bit sort of pre-seed and seed, I think. But, when I cast my mind back to that stage of Avio's journey and my own journey as a sort of young tech entrepreneur, I know that I would have really valued understanding what's further down the road in the life cycle of a technology business and in the sort of the transaction space, and what I learned going through the Avio journey about what happens at that stage of transactions and fundraise. I really wish I'd known much earlier. I kind of think that I would have made smarter decisions on the business. So by way of full disclosure, Chris, you and I worked together on the sale of Avio. You were SilverPeak were the corporate finance advisor to Avio during 2022 on the sale of that business to US-based SHR. So I really couldn't think of anybody better to come on and sort of be interviewed in terms of just picking your brain and demystifying some of the space for some of the Voyria audience. So thank you again for doing that. Can I come back? You mentioned again a number of key things around M&A and deal types and equity raise and debt and Series A. What are the types of transaction typically that SilverPeak would work on, Chris?
Yeah, so I suppose broadly, we do advise and support across the full spectrum of financing and exit options that companies um, can take advantage on. But we specialize really in helping growth technology companies source equity-led financing or achieve liquidity events. So I'll take those two examples. On the equity-led side, these are typically Series B, Series C rounds, and I'm focusing my context here on software, because we do more broadly advise technology companies in the areas of deep tech as well and digital services. But for this audience, this is more relevant on the software side.
Mm-hmm.
So I would engage a company that is at a reasonable scale that is looking to raise a Series B or Series C round. How I define that financing round is essentially growth capital, whereby there is already a product, there is some traction and momentum in sales, but they're looking to raise financings to build out the team, particularly on the sales side, and really try to supercharge the growth, and scale the business. More importantly, with a sophisticated investor coming on board.
Right.
From a liquidity event standpoint, which is also where we specialize, essentially what I'm saying is a recapitalization whereby some shareholders will exit. For example, older angel investors or VC investors that are looking to exit, whereas management want to stick on, and continue to create value in the business. That is essentially a recapitalization, and it could look like a minority or majority buyout with a new
Mm-hmm.
investor coming on, or it's a full exit, i.e. all outstanding shareholders exit at that liquidity event, and we manage that transaction throughout.
Right, and that was the transaction, of course, that happened with Avio for SHR. Okay, very useful.
Exactly. Yep.
So can we move from sort of setting the stage then to diving into what a typical transaction process would look like? Again, I think not that all transactions are similar, but for an entrepreneur that has not gone through something like a Series A or a Series B round, could you paint a picture and give us a sort of a general overview? Are there key stages that crop up, during each transaction? Is there a general sense of timeline or milestones, that kind of thing?
Yeah, sure. So I'll try and keep it as broad and general as I can, covering both M&A and financing. But as you rightly say, Frank, every process and every journey is different. So these timelines are certainly not rules by any means, but they're good guidelines that I would say average out on most of our processes. So a typical corporate finance project should last between 8 to 12 months. There are certain situations where they can close quicker, but on an M&A and financing round, I wouldn't expect that process end to end to last longer than a year. The preparation phase is the most important. Now, that can take typically between 2 to 3 months, but what I encourage entrepreneurs is spend as much time and as long as it takes really on the preparation side, because as soon as you are prepped to go to market and have conversations with investors and buyers, and you're aware of the sorts of questions that they're going to ask you, it expedites the back end. At the point where you're doing the due diligence internally to address some of the challenge posed by the investors and buyers, is really at the point where you sort of lose momentum and track of the process. So preparation is key really to successful processes. In terms of what that preparation looks like, it typically involves SilverPeak supporting management and shareholders in creating marketing materials. So this could be by way of a information memorandum, which is essentially a document outlining what the business does, why it wins, and what the growth and equity story is going forward. We'd also be heavily involved in developing the financial and operating model, typically on a 5-year look forward basis, so that investors and buyers can start to think about what this business looks like going forward, what is the investment case, and then also it feeds into valuation. As just as important, there's a comprehensive data cube data cube, the way I describe a data cube is essentially an Excel workbook that allows you to cut information in different dimensions. So this is more focused on the commercial side of a business. So take, for example, a software business that has monthly recurring revenue. We would essentially create a data cube so that investors and buyers can understand the trends and cohorts and vintage analysis, everything that they would need to know around what the trend looks like for that business, how you operate with customers and how they're growing within the company, and also how you're attracting new customers. So that we spend a lot of time, because ultimately articulating the right equity story is important, but you need to overlay that with key financial metrics. And then finally, I should mention, and this is more at the later stage of processes, more on the sort of recapitalization or sell side, which we did with Avio, is we could consider conducting vendor due diligence on the company itself, essentially involving external advisors to do an independent review on the quality of the business, which then bidders at a later stage of the process will rely on. So that in a nutshell is the preparation phase. You then move into the next stage, which is engaging with investors and buyers. And at this point, I like to define this phase as the exploratory phase. This is the first round of conversations with investors and bidders that are getting to know your business, getting to know the management team, and essentially speaking internally as to whether they want to consider submitting an initial non-binding offer. This typically takes a month, and then typically followed by another month. And during that month following, it's our role where we look to improve the offer. We look to get a better understanding of the offer in its totality. And so, this phase would take between 1 to 3 months. At the point when you've outlined who the preferred bidder or bidders are, whether it be from an M&A or financing perspective, I suppose from a finance perspective, you'll be spending more time with the lead investor, and then just simply getting the follow-on investors bought into the consortium and agreed to the term sheet. We would then enter into a phase, how I like to define the confirmatory due diligence phase. And this is essentially where you share as much as you can with the bidders and investors by way of a virtual data room. And it's important to disclose as much as you can at this stage. And that confirmatory due diligence phase really should confirm what they already understood in the exploratory phase. And therefore, it should be a case of addressing questions, providing more time to management, and addressing also questions from external advisors should they use to onboard them at this stage. I would say this typically takes between 1 to 3 months as well. 1 month more typical if you've already conducted the vendor due diligence in the preparation phase, or more typical 2 to 3 months if the buyer is having to conduct that themselves on their end.
Very good. Thank you. You've mentioned due diligence and vendor due diligence. Could I ask you to help us sort of tease out what due diligence is? What are the different typical types of DD, as it's referred to, that can come up in deals, and indeed where do the lawyers come in, and how many different types of lawyers do you typically see in a transaction?
Yeah. So again, due diligence does vary depending on the type of buyer or investor, but typically you would see due diligence covered in these areas: financial and tax, legal due diligence, technology due diligence. In some instances, we also are seeing people conduct ESG due diligence, corporate social responsibility as well. Some management due diligence as well, getting to understand the management team behind the company, and going deep into their characteristics and traits and strengths. But I would say those are the core streams of due diligence. When I talk about vendor due diligence, essentially what I'm saying is all those areas of due diligence that we anticipate a buyer to want to cover at the back end of a process, we conduct it during the preparation phase. The benefit of doing that is essentially you get to understand any challenge that may be raised at the back end of a process, and it allows the company to address some of that challenge. So if there is a certain issue with a certain accounting policy adopted, for example, in your management accounts, we can look to reformat or restate your management accounts so that when we come to a process, everyone is aligned in terms of what they're valuing, and people are comfortable with the fact that you've had an external advisor look over the management accounts, and that they therefore stand behind that due diligence rather than conducting it themselves. It also, from a competitive standpoint, allows us to go into a process and ask bidders, before we even consider exclusivity, to stand behind the vendor due diligence. And therefore, this really feeds into trying to reduce execution risk. Essentially, what we're saying here is we've just conducted due diligence over 2 years of accounts, if we stick on the financial tax due diligence piece, and we are asking you to stand behind that work and conduct top-up due diligence between the point where that report was finalized and the point where we complete. Now, the benefit from us is if they stand behind it, the due diligence process on those 2 years historics doesn't have to happen. All we're focusing on really is the point where that report was finished and the point between closing, which will typically be between 3 months. So there is a lot of value in vendor due diligence, but I would caveat with the fact that, and you'll know this, Frank, there does come a cost attached to that vendor due diligence, which is a fixed cost. So you have to think of it as a sunk cost as part of the process. But should you complete a process, it typically gets wrapped up as part of the transaction cost anyway.
Yeah. Excellent. Okay. I think back to one of my earlier questions about terminology and framing, as you did, the difference between, SilverPeak on the corporate finance advisory space versus someone like a broker. One of the things that I find to be least misunderstood when I speak with, again, earlier stage entrepreneurs is they assume that, a transaction with a partner is going to, they have to do most of this work themselves, right? And there isn't the vast degree of support that a company like SilverPeak will offer. What other areas do you find are not well understood, or perhaps least understood by companies, by management or entrepreneurs as they go through a process like this? Does anything stand out?
Yeah, good question. If I focus the question on an M&A event that you and I went through, I would probably say that the least understood aspect of a process that I come across with entrepreneurs and educate them on is the difference between the headline price and the final net proceeds number that is essentially going to be paid to the shareholders upon an exit. And solid commercial advisors at this point add significant value, ensuring that no money is left on the table, in bridging that gap between the headline price is what you'll get in a non-binding offer, and a headline price is interchangeably also called the enterprise value, versus what is the final number that shareholders will get pre-tax. And the analogy I always use with entrepreneurs that I engage with is essentially selling a house. So if you consider the market value of a house to be X, clearly as an owner of that house, more often than not, unless you have no mortgage, that's not the amount that you will be taking home as part of that sale process. So you need to consider factors like how much is outstanding on the mortgage, what are the repayment charges, what is the cash value of any furniture you leave behind, what is the condition of the property. And this essentially is negotiated with the buyer and determines what the net proceeds is payable to the owner. This is a very similar way, albeit more complex. I'm not suggesting that we are just real estate agents by any means, but I find this is quite a powerful analogy to explain that in the first phase of going to market, you'll receive non-binding offers on a cash-free, debt-free basis on the value of your company. Now, that is helpful, but there is still more negotiation that takes place to understand how much this business really is worth to the shareholders. And at that part, that's where a solid commercial advisor, as I said at the start, drives significant value, because that's where we come in from a technical perspective. We model out what that completion mechanism looks like, and then we get all shareholders comfortable in what number is palatable from a net proceeds number, not an enterprise value number.
Yeah. This is, I think, just one of the areas that we've touched on that I think, whilst it might be a year or a couple of years down the road for some of the people listening to this, it's so useful to think about these things earlier in the life cycle of a business, so that you can make decisions earlier that will lead to maybe an impact on valuation further down the line. I do think that moves us nicely onto the sort of the broad topic of valuation, Chris.
Yeah.
And again, I'm going to ask you to in a very general way, but when we look at how entrepreneurs or business owners create value, I mean, when you think about valuation, are there kind of golden rules that you look for in a company that you're going to be advising, or how entrepreneurs think about some of the best ways to create meaningful value during and at the end of a transaction?
Yeah, there's certainly rules that investors would adopt, and these are case by case, fund by fund, depending on their certain criteria, depending what type of investor they are. Are they looking at growth investments? Are they looking at value investments? So golden rules, I would say, are widely adopted on the investing side, but they are different. And therefore, I always encourage entrepreneurs to consider not what clearly you need to take into account, what the right type of investor or buyer is for your business in that type of event, but really identifying your own North Star metrics that are really driving value and performance in the business, or is a function of value and performance in your business. And the way I define that is probably maximum 3 North Star metrics that you and your management team should hold yourself against and constantly monitor to ensure that they're trending positively and they are delivering against what good looks like in that specific industry, and also at that specific time, because clearly market conditions change, and these North Star metrics, the importance of them also move. To give a more specific answer on what type of North Star metrics there are, I could say for high growth SaaS companies, which is more relevant for your audience, examples could include gross revenue or gross revenue retention, for example, which is essentially looking at your revenue at the start of the periods and any churn that's occurred within those accounts, and ultimately you're trying to understand the product mission criticality and customer satisfaction for your product, which also then feeds into your moat and also feeds into the competitive landscape that you find yourself in. What good looks like from a gross revenue retention perspective is typically nothing no less than 90%. So essentially what I'm saying is not witnessing more than 10% churn. Mm-hmm. Again, this does differ depending on industry. If you're more focused on B2C, that churn rate may be a bit higher, but actually when you dig into it, your ICP, your ideal customer profile, the churn rate may be not as great, but the longer tail of consumer customers that are coming in using your product once and then leaving, that may be greater, so distorting the picture. But this is sort of kind of giving you a more general view of what good looks like. The other one that I'm sure most entrepreneurs are familiar with is the rule of 40. Essentially, this is a combination of revenue growth plus profitability, and ideally the base should equal 40% or above. Now, coming back to that point around market conditions, the weight and importance of that rule of 40 has shifted somewhat, particularly in this environment where capital is more expensive and investors are less likely to invest purely in marketing dollars and growth at all costs. So we're now finding in this environment that investors are, at the very least, want to see some path to profitability. And actually, how can you sustain this business on its own operating cash flow going forward, not growing at 80% with a high cash burn, with no immediate or medium-term outlook of when this business can become profitable. So there are two examples of North Star metrics for SaaS companies. But to come full circle, I encourage entrepreneurs to really think about what is important in their industry and what metrics do they want to measure themselves against their own success.
That's great. And again, I think it's such another critical area that is, not as obvious for earlier stage entrepreneurs, that there probably are somewhere 3 to 5 metrics that will be the headlines in terms of where that sort of business valuation will come from. I think it's quite difficult sometimes in the noise of everything that goes on from day to day within a business to extract what those metrics are. But I think an earlier stage focus on those could only set the business up in better shape vis-a-vis valuation.
Absolutely. And just quickly on that point, because I completely agree, is that investors and buyers will spend a lot of time on historical trends. So the quicker that you can identify what's important as North Star metrics and try to improve those metrics, you give yourself a longer track record to evidence that these are strong metrics, and that will feed into valuation, as opposed to only understanding that these are your North Star metrics at the point when you do a process, try to improve them in the short term, but bidders and investors considering it not to be sustainable going forward.
Yeah, absolutely. I mean, with all that said, Chris, clearly, as you've articulated, there is still scope for enhancing valuation during a transaction process. I'm not going to push you on giving away some of the SilverPeak secret sauce, but maybe you could sort of paint a high-level picture of how a firm like SilverPeak would work and think about the best ways to enhance that strong underlying valuation.
Yeah, it's really repeating a couple of topics I mentioned in your previous questions around focusing on preparation is of the utmost importance in my eyes, because as soon as we all understand the equity story, the data behind that equity story, the type of investor or buyer that we want to speak to, the narrative, the value to the investor and the buyer, and can address any potential challenge coming our way, is when you can ensure that you maintain competitive tension, because you're addressing questions quite early on, you're giving them the answers, and you're holding them to certain milestones when it comes to first, second, final offers. And that's all important. And actually, this is clearly a point outside of the value of the company. Having multiple interested parties improves price naturally. It's a supply and demand dynamic that everyone's very accustomed to. So preparation is of the utmost importance in my eyes, and our secret sauce. And also within that preparation, coming back to the whole key metrics point, it really getting into the numbers. And for example, I mentioned gross revenue retention, but cutting that up in different cohorts of size of customers or different types of customers, or how long customers have been around for, you can cut that in so many different ways and dimensions. And spending a long time in really cutting through the noise and understanding the business in a granular detail is exactly what an investor will do. So the more technical analysis that you perform, the better you'll be equipped in answering questions down later in the process. So yeah, the best possible route to ensuring the highest valuation is just addressing all the potential challenge and bringing through all the opportunity during the preparation phase, ensuring that the story is aligned between management, shareholders, and advisor, and then going to market and maintaining that competitive tension.
Fantastic. Thank you, Chris. Just before we wrap up, could I maybe press you on a key bit of advice or a couple of key bits of advice that you would give to, again, earlier stage entrepreneurs that are maybe not yet ready at the stage of their business to engage with SilverPeak, but want to be thinking about setting their business up for the best possible transaction? What advice would you give to some of the Voyria audience of entrepreneurs that are earlier?
So I would encourage entrepreneurs quite early on, and don't be put off by the fact that we typically advise later stage companies, but pick up the phone and speak with advisors like myself to gain insights on market conditions and get a better steer on what a potential route looks like for a shareholder and what options that they have available. Most mid-market advisors like me really do enjoy and encourage building relationships at the early stage of an entrepreneur's career, because firstly, we can follow that entrepreneur's career's journey and support them. But secondly, before it gets to a point where an engagement makes sense, we've already become the de facto advisor. We already stand the business quite intimately. We've already built a relationship predicated on trust with the entrepreneur. And then from an entrepreneur's perspective, they have a far clearer idea of what the next stages of their company's lifestyle looks like and the options that they have. And also they can then contextualize that with the current economic backdrop, which then feeds into timing. So to answer your question, I would encourage speaking to people like myself or other mid-market advisors, building on that relationship, keeping them up to date over your journey. And then when it comes to the right time from an entrepreneur to consider a liquidity event, whether that be a financing round or M&A or something else, you already have that network that you can then have a conversation and engage quite early on.
Great. I would really echo the value of that early engagement, Chris. I mean, what I learned going through the process in 2022, you know, I picked up so much knowledge and insight, and I really did wish that I had gained some of that intelligence earlier in the process. So yeah, I would absolutely echo the value in early engagement, even if it's not quite the right time to formally start a process. I think all the benefit of what is learned through those conversations are really invaluable. Chris, I want to thank you so much. You've been very generous with your time, so thank you again, and thank you to SilverPeak. And we shall say goodbye and leave it at that.
Thanks for having me on, Frank.
Thank you.